Hello and Happy New Year. Welcome to the first tax roundup for 2015. And what a year it's going to be. We're expecting a huge amount of change across tax, accounting and superannuation to either be announced or enacted this year. Now, some of those changes came through late in December with the mid-year economic review, which had a lot more than just a $10.6 billion blowout. Mike Carruthers explains.
Well, just before Christmas, the government released its mini-budget. And while there weren't any massive changes announced, there are a couple of things that are worth being aware of, particularly for those people advising small, medium businesses. The first one was around the tax treatment of in-house software. So in-house software is software that you've bought or developed to use in-house, internally. At the moment, in-house software can generally be depreciated over a 4-year period. The government plans to increase that time period to 5 years, and that would start from 1 July 2015. So it won't impact on software that people already own and are using. It would only impact on software that is first used or installed ready for use from the 1st of July 2015 onwards. The other change that has been proposed, and this will be good news for a lot of small businesses that sometimes have issues around superannuation guarantee, is hopefully some really sensible changes to the super guarantee charge rules. One of the key, issues that people have with this is once you've missed that super guarantee obligation, you're into the super guarantee charge regime, and you've got the interest component, the admin component, and actually calculating the super amount as well. And one of the issues that people have always had is that calculating the super amount under the charge, you're actually using a different earnings base than what you would have if you'd just paid the super on time. So the government has kind of listened to the comments a lot of people have made on this and has said that they will make the two concepts similar. So we'll be using ordinary time earnings for both of those calculations. So you don't end up with a separate calculation just because you missed the payment by a day. So some sensible changes. We're yet to see the full detail around that. We're also expecting some changes around how the penalty system works and the interest system works as well. And the government says it's to more closely align the super guarantee charge penalties and interest with the normal penalty and interest regime that applies for other tax reasons. So we'll see more of that hopefully in the coming months, along with possibly some other announcements by the government as part of the tax white paper that we're expecting quite shortly. And on top of all that, government has kind of responded to the Board of Taxation around the review of tax impediments for small business. So again, over the coming months, hopefully we'll see some meaningful and sensible reforms starting to filter through the system.
If you've appointed a friend as the executor of your will and you've left them a small payment to take care of all that trouble and hassle they're going to, then this next ID will be of interest to you. Ray explains.
Now we have a combination of two classics, death and taxes, with the Commissioner recently issuing an ATO ID which confirms that when an executor receives a payment from an estate in relation to performing services managing that estate, it is assessable income. Now this might seem like a really basic point, but if you think back, a couple of decades ago it was usually the accountants and the lawyers that were the executors, so there was an expectation they would be paid a fee for those services and they were performing them in their professional capacity and therefore it would be income. Nowadays it's a lot more common to have a friend or a family member act as the executor, and the deceased might think, well look, I'm going to leave them something to say thanks for taking care of all the trouble. Unfortunately, if you're leaving it to them in their capacity as an executor, then it will be an assessable income. So thanks for the memories and the tax bill. However, if the person is leaving something in the capacity of a beneficiary, then obviously that would not form part of the assessable income. So it's really important to remember, when you're asking your mate or your best friend or your family member to be the executor, make it really, really clear, if they are getting something under the will, in what capacity are they getting it? So don't forget, talk to the lawyers and make sure it's correctly phrased in the will, and don't leave them with an unexpected gift of a tax bill.
Hopefully you're feeling rested after the Christmas and New Year break. But before you get too busy, it's time to look at some of those jobs you didn't quite get time to do late last year. If one of those is protecting your clients against the cost of audit by the regulators and the ATO, then now's the time to give Accountancy Insurance a call. Give them a call on 1300 650 758 or take a look at the website accountancyinsurance.com.au and have a chat to them about Audit Shield before you get too busy again. But now Michael Carruthers is going to take you through a new ATO ID for all those budding internet entrepreneurs.
Now, the ATO has released an ATO ID that will be relevant to any budding YouTube entrepreneurs out there. ATO ID 2014/41 deals with the application of the special rules for performing artists in relation to someone who was earning income from a YouTube video or a collection of YouTube videos. Now, basically the situation this ATO ID deals with is someone who was producing a regular series of YouTube videos. It was basically a cooking and baking type show that they produced themselves. They starred in, they did the voiceovers, the editing, basically produced the whole thing, uploaded onto YouTube, and they were earning revenue from that. So a share of advertising revenue, that little ads that go across the YouTube clips, and also based on the number of clicks and number of hits they were getting. So the question actually raised here was not whether the payments were assessable. We were really starting from the assumption that these payments would be assessable income. It was more about whether this person who was earning the income could qualify for the averaging rules that are available to special professionals like actors and actresses. The ATO confirmed that in this case, yes, they could. So the income was being derived in relation to a film. So a YouTube video was something that could be classified as a film. The person involved was a performing artist. They were actually appearing in the videos. So the ATO was happy that they were a performing artist, someone who was appearing in a film. And they were also doing a lot of the editing and production as well. So the ATO also found that they could have actually fallen within a couple of categories to qualify for those special averaging rules. So, interesting one. Some of you will have clients who are involved in some of these slightly different areas that we haven't had to really pay much attention to until probably the last few years. So ATO is starting to catch up in terms of issuing guidance on some of these areas. So important things to take away from this one. Someone who is earning income, is earning regular payments from something like a YouTube video or a collection of YouTube videos, very likely to be assessed on the payments they're receiving. But on the other hand, they might get the benefit of some tax concessions to average out how that income is actually taxed.
Residency is always a hotly contested issue, and in this next case, Ray looks at a win for the taxpayer, even though his family was still domiciled in Australia.
An interesting case now regarding an individual tax residency situation. The case is the Engineering Manager versus Commissioner of Taxation, an AAT case, and due to the details involved, the taxpayer is referred to as Mr. M. So what happened here is the taxpayer had been living and working overseas for many years, but this case only looks at the 2011 tax year. Normally, the Commissioner says, even if a taxpayer is domiciled in Australia, even if they have accommodation overseas, if the family is here, then the individual is more likely to be considered an Australian tax resident, particularly if they come back and visit on a regular basis. In this particular scenario, the taxpayer worked overseas in Oman. He had a permanent place of abode available to him there. And the AT went through all the facts and determined that for this particular taxpayer, his work and his career was his priority. All his other commitments revolved around that particular priority. So therefore for him, it was very, very clear that when he was living and working overseas, that was where he was resident, not in Australia. Even though his family was here, he retained some property here with his wife, and he did come back and visit on an occasional basis. It was only when the taxpayer actually moved back to Australia in April 2011 for family reasons that he considered himself to be a tax resident of Australia again. And although the Commissioner had sought to tax him for the full tax year on the basis of being a tax resident, including the overseas income, in this particular case the AT supported the taxpayer and said no, he's not yet a tax resident of Australia until he moved back in April 2011. Prior to that, he was a non-resident even though the family was here. An interesting case that helps the taxpayer.
And that's the tax roundup for this month. Don't forget, if your firm is not a member of Knowledge Shop, you're missing out on work papers, a technical help desk, free PD, and a whole lot more, all for the one price and no lock-in contracts. Why don't you give Julie a call on 1800 800 232 and have a look at what's on offer. See you next month.